We are again going to look at exchange rates in this module, and I'm going to do three things in this module. First, just go over the exchange rate markets one more time. Second is to clarify what we were discussing in the last class regarding the US dollar China renminbi situation, and I misspoke in that class, and I want to clarify that. And then finally, talk about some markets that companies can use to protect themselves against undesired exchange rate changes or changes in exchange rates over time. So that's the outline for this module. There is a market for exchanging currencies, one for another. Though that foreign exchange market operates continuously daily. It on average transacts about $1.2 trillion per day, and it's a mostly over-the-counter market, just swaps within over-the-counters, nothing, no formalized exchange. Here you see a list of countries, currencies, and their relative share of the market. This, if you look at the bottom, will total 200% because obviously if we're exchanging, for example, one currency for another, there's two currencies involved. So it'll total 200%. US dollar represents most of the currency exchanges, 85%, followed by the euro and the Japanese yen. Again, just a feel for the size of the market, and to note that the US dollar makes up a pretty large portion of that market, followed by the euro and Japanese yen. There are two major uses of exchange rates. The first is obviously for trade, or trade with companies, or for that matter individuals in other countries. As companies do business outside a country, they often will need to exchange currencies to do business in the other country. The other use of exchange rates is in stating financial statements. All companies have a country home and do need to prepare financial statements. If they're a public company, they need to make those statements public, and all of the operations of the subsidiaries outside of the country must be stated in terms of the currency of the country that they're in. So if it's a U.S. company, all operations outside the country, whether that's in Brazil, Euro, all of those income and other items must be, or expense items must be stated in terms of the home currency. So exchange rates are used to make the transformation of those financial statements back to the home currency. Currencies or the exchange rates are published. Here's an example from the Wall Street Journal from February 6th. Here the first item on that is a Japanese yen, and its exchange rate from US dollar to Japanese yen. In this case it's 93.56, which means that $1 will be buy 93.56 yen. Second item line there is the euro, and here this one is stated euro to US dollar. So $1 will buy 1.35 or 1.3522 euros in this case, and you can see the others are stated similarly. Pound, Great Britain pound to US dollar. If you've been following the news here lately, UK is in the EU. It doesn't share the currency, or it doesn't use the euro. And now it's going to be placed up to vote whether the UK remains in the euro. So we'll follow that as time goes through. But in any case, here's a list of some of the major currencies and their exchange rates as of February 6th. And obviously those exchange rates will change daily, minutely, or they'll change quite often. And obviously then that introduces exchange rate risk for countries doing business outside or across borders. I'm now going to give an example of weakening and strengthening of currencies. Here's an example of weakening currencies, and the next one will be strengthening currencies. I'm going to go over this again. I know I flubbed this for the Chinese situation, so we're going to go over this again, and we'll do this first for the euro and then for the Chinese yen. Here in my example, we start out with 1 to 1.3 euro. So that would be stated USD to euro. $1 equals 1.35 euro. You can state that equivalently as $0.74 to 1 euro. And the 0.74 would be 1 divided by 1.35. All of these are reciprocals of this. In any case, what this means is $1 will buy 1.35 euros. Now, going down the slide a little bit, we have a market change and we go from $1 to 1.25 euros. So we went from 1.35 down to 1.25, and that's a weakening. The dollar, a weakening U.S. dollar. And it's obviously the counter of that would be a strengthening euro. But the weakening U.S. dollar, so U.S. you can buy less euros for one U.S. dollar, and again, it's the opposite for the euro. The euro has strengthened relative to the U.S. dollar. But what the weaker U.S. dollar causes is that European goods cost more to Americans. And here, 1 euro used to get $0.74. Now it only gets $0.8. So if good cost $1 in euros in Europe, it used to cost 0.74 here in the United States. Now it will cost 0.8. Conversely, U.S. goods will cost less in Europe, and it used to be, if we had in this example, it weakened. So $1 a good that cost $1 to make in the United States would cost 1.35 in Europe. Now it cost 1.25. So this weakening of the dollar would make European goods cost more to Americans, and U.S. goods cost less to Europeans. Now we're going to have the reverse case, or the U.S. dollar is going to strengthen relative to the euro. Again, we begin in the same place, $1 to 1.35 euros. Now we're going to have the market change to $1 to 1.45 euros. This is a strengthening of the U.S. dollar, and it will cause European goods to cost less to Americans. Something that used to cost 1 euro to make in Europe used to cost 0.74 cents in the United States. Now it costs 68 cents. And we get that 74 and 68 from above there. And U.S. goods cost more to Europeans. So something that cost $1 to make and transport to Europe or if it cost $1, it used to, before the currency move, cost 1.35 euros. Now it costs 1.45. Obviously, then the concern here is that if countries manipulate exchange rates to either make imports look better or worse, that they're manipulating the market and not allowing free trade to operate properly. We ended on Monday talking about the U.S. dollar versus the Chinese renminbi. Here's a chart that shows the U.S. dollar to China exchange rate. As you can see there, it was pegged at 8.2, roughly 8.2, up to May 2005. And then since that point has been steady but going down. Again, China doesn't allow its exchange rate to float freely, and that does cause concern. And again, we're going to talk about the example here and that the piece of paper, or the paper that I handed out in class, which is also on the website. For a long time, as you can see in the previous slide, and this was prior to May 2005, the U.S. dollar to Chinese currency was pegged at 8.2, which means that $1 would buy 8.2 of the Chinese currency. It then moved down to 0.68. $1 would then buy 0.68 Chinese yen or renminbi. This was a U.S. dollar weakening relative to the Chinese currency, and $1 used to buy 8.2, now it buys 0.68. This does cause a Chinese good to cost more to Americans. All else equal, it's bad for imports. And U.S. goods cost less to the Chinese. All else equal, it's good for exports. And again, since the U.S. exports agricultural goods to China, this would be presumably a net positive for exports. Having said that, we don't see much of a linkage in empirical studies between exchanges and exchange rates and what happens to trade flows in the agricultural commodities, probably because um, needs for exchange in agricultural markets are dictated by weather and yields, which are largely independent of exchange rate changes. Um, Overall, though, in this example, and this is the fourth bullet point there, the Chinese currency did strengthen, and the concern was that they stopped allowing it to strengthen. There were many and economists and others in the United States that believe that the Chinese currency is undervalued, and China should continue to allow its currency to increase. So the controversy isn't that the Chinese stopped or weakened their or caused their U.S. dollar to weaken, but that they didn't continue to do so, and they stopped that appreciation to some extent in 2008 during the financial crisis that occurred during that year. Just a couple more notes here about currencies and stating of exchange rates. Here we wrote the US dollar to euro 1.25, and what that means is that 1 US dollar can be exchanged for 1.25 euros. That would also mean that the euro to US dollar would be zero point 0.8, and that means that 1 euro can be exchanged for zero point 0.8 US dollars. Note that those are reciprocals of one another. The zero point 0.8 equals 1 divided by the 1.25 US dollar to euro exchange rate, so they do have to be reciprocals of one another. Here is a typical exchange rate table. This comes from the Wall Street Journal on February 5th. A table listing the exchange rates. Here, the exchange rates on the base exchange rate is listed on the horizontal axis, and then the vertical axis gives the other one. But just to take an example here, let's look at the euro versus the US dollar. So you find the euro on the horizontal axis, go down to the US dollar, which is the very last line. So the euro is the second column in as far as numbers. US dollar is at the bottom there, so that'd be 1.3533. That would mean that the euro US dollar exchange rate is 1.3533. Note you could get the reciprocal of that by doing the dollar to the euro, which in this case is dollars given in the first column, euros in the second column, or excuse me, dollars in the first column, euros in the next to last row from the bottom is 0.73893, and those would be reciprocals of one another. 0.73893 would equal 1 divided by 1.3533. The yen US dollar, and just to give you a couple other examples, there you see the yen US dollar is 0.01065, so go to the yen, which is the second to last column. It is 0.01068, and the final currency we give there is US dollar to yen, and that in this case is, find the dollar in the first column. Japanese yen is second row down, so dollar to yen is 93.610. And again, 93.610 equals 1 divided by the yen to US dollar exchange rate of 0.01068. One of the characteristics of exchange rates is that you shouldn't be able to make exchanges through currencies and end up better, or for that matter worse off, than by making the straight exchange. And I'm going to exhibit or illustrate that in this slide. Again, if you could do that, there's unequilibriums that exist in this market, and you could make money. Let me start here and start with the rates in the first column. So US dollar to UK pound is 0.63910, and that 0.63910 came from the previous slide. The UK pound to Swiss franc is 1.4248, and again I'm still on the rate column there. The Swiss franc to the Mexican peso is 13.918, and the peso to euro is 0.05830. All of those rates are exchange rates, straight exchange rates from US dollar to UK pound. Second line is UK pound to Swiss franc. Third line is Swiss franc to Mexican peso. Fourth line is Mexican peso to euro. All right, if you look at the multiple line, you'll see there that in the line with the UK to Swiss franc, there's a 0.91060. And that 0.91060 equals the exchange rate of moving the US dollar to the UK pound, 0.63910, and the UK pound to the Swiss franc of 1.4248. Multiply those together and you get that 0.91060. That number is the multiplication there is given in the line below the heavy black line, just multiplying the US to the UK pound and UK to Swiss franc exchange rates. What that 0.9106 represents is an exchange from US pound to UK, or excuse me, US dollar to UK pound, and then taking the UK pound to the Swiss franc. So we made two exchanges, US to UK pound to Swiss franc. You will note that that 0.91060 is the same, go to the previous slide, as the US dollar to Swiss franc currency exchange. And that again has to be if there's equilibrium in the market. We shouldn't be able to exchange funds across different currencies and end up with more currency doing the exchanges than doing the straight US dollar to Swiss franc. So if that number, that 0.91060, differed from the exchange rate, straight exchange rate, we could either make or lose money depending on the relationship there by doing a transfer from US to UK pound and then UK pound to Swiss franc. The third and fourth line, Swiss to Mexican peso, we do the multiplication again. That 12.674 would represent an exchange of the US dollar to UK pound to Swiss franc to Mexican peso. Are two changes of currency. And again, you'll see that that multiple, 12.674, is the same as the US dollar to the Mexican peso. Peso to euro, do the same thing. And again, here you can't, and the important thing to illustrate here is you can't go through multiple changes and make money, or for that matter, lose money. Obviously, this does abstract away from transactions cost, and you would expect some transactions costs to make any sort of these exchanges just to compensate the person making the exchanges for those currency exchanges. I'm going to now give another revenue example, and here I'm going to use two different exchange rates, one on September 15th where the euro to US dollar was 1.4175, and on November 11th when the euro to US dollar was 1.276. Here's the situation. Let's say a US company agrees to sell goods to a European company for €1 million on September 15th, and the transaction will occur on November 11th. So there's a little bit of time between September 15th and November 11th. And the U.S. company wants the U.S. dollars, so we'll exchange euro for U.S. dollar on November 11th. On September 15th, the 1 million euros would generate 1.147 million U.S. dollars. On November 11th, the 1 million euro would generate only 1.276 million US dollar. Here, the strengthening of the US dollar loses revenue for the firm exporting. Here's the opposite example. Same exchange rates, but now the U.S. company agrees to purchase European goods for 1 million euro on September 15th, and again the transaction will occur on November 11th. U.S. company again wants to exchange those funds back on November 11th, so on September 15th, the one euro would cost $1.4175, and on November 11th, it would cost 1.276. In this case, the strengthening of the U.S. dollar reduced the cost to the U.S. firm. Um, Both of those cases introduce uncertainty, and in a lot of cases, firms don't want to deal with that uncertainty, so they'll make some sort of exchanges within currency markets to make sure that those exchanges that in this example occurred on September 15th or were agreed to on September to November 11th, that exchanges rates don't either change the cost or the revenue to the firm. Here are some of the transactions that occur in the exchange rate market. Spot transactions are where two parties agree to exchange in the spot market, and that would be at the cross rates given above. 32% of the transactions occur at that level. Outright forwards, parties agree to exchange currency at a specific rate, some futures date, 11%, and then there's also foreign exchange swaps. And here the companies exchange funds immediately in return for a specified price later on. So they agree to exchange funds now, and they also agree on the rate at which those exchanges will be exchanged later on. And a large amount of the transactions occur in this manner. There are swaps of funds now with agreed on exchange rates at some point later in the future. Just to illustrate a foreign exchange or a swap, let's say a U.S. firm needs 1 million euro for a 3-month investment. They would agree to swap 1.25 euro right now for $1.25 million for 1 million euro for a period of 3 months, and then agree to swap it back in 3 months. So that is one form of a foreign exchange swap. You could have more firms involved in this, and so that one firm may agree to the swap, and so there could be multiple individuals involved in the swap. But this just gives an example. One case, U.S. firm needs money for a while, and they agree on this sort of swap relationship. It's important to note that exchange rates in the future, forward exchange rates, we have the spot rates that we can make exchanges today. A forward exchange rate is something that we're going to trade in the future, and those will not necessarily equal to today's exchange rate, and that's because of differences in interest rates across the countries. If you don't account for interest rate differentials, you can introduce arbitrage and profit opportunities, because individuals would take funds, move it to a different country where they had a higher interest rate, and then exchange it back at some other point in time. So forward rates need to account for interest rate differences across countries. This is not as important currently when we have very low interest rates, but it is important in higher interest rates environments, and some countries that do have currently higher interest rates than the U.S. does. I'm going to give an example of this, and let's just put together some notation here. Let's say the current value of a domestic currency is C sub D, current value of foreign currency is C sub F, and then the forwards. Here the spot exchange rate is C sub D divided by C sub F. Again, if this was US versus Euro, this would be the spot exchange rate. And now we're going to solve for the forward exchange rate, and we do need to take into consideration the interest rate differences across these countries. Here we denote the interest rate in the domestic market as I sub D, foreign interest rate is I sub F, and we're going to compound it for n time periods. If we start out in the domestic currency with a certain amount, C sub D, future value of that will be current value times 1 plus the interest rate plus the proper compounding period. Similarly with the currency in the foreign market, same sort of calculation will result in the future value in the foreign market. And here is the derivation of the forward exchange, the relationship between the forward exchange rate F and the spot exchange rate S, and that is related by the interest rates in the respective countries. Again, S here is the spot exchange rate. F here is the forward exchange rate. And again, that would be some period of time in the future. If the interest rates were the same across the countries, spot rate would equal the forward rate. Here is an example of a Canadian to US dollar currency, and let's say that spot rate is 1.29. Canadian interest rate is 4%, US interest rate is 3%. We're going to compound it forward 4 months, or 0.333. If the current spot rate is 1.19, then the forward rate would be 1.186. So this gives you the relationship between forward and spot rates. We'll run through a couple of examples and have a quote-unquote little quiz on this next Monday in our class. We'll just run through a couple of examples during the class of these forward and spot rates. So be prepared to do this in class next time. Alright, so what this module did again was just go over the foreign or exchange rate markets. It talked about the China example that we first discussed in this class, and then talked some about the markets that exist for exchange rates, and in particular when we're looking at forward rates, and then discussed parity, which is important in the forward markets.